Welcome everyone. If you are self-employed, a small business owner, give me a moment, let me check the volume here. One moment, please. Test, test. Test, test. Okay, I think the volume is working fine now. So again, welcome everyone. If you are self-employed, a small business owner, or just someone looking to supercharge your retirement savings, you've probably heard of the solo 401k and maybe even the mega backdoor Roth. But here's the catch. While they sound similar, they work differently. And if you don't understand the differences, you could miss out on thousands of dollars in tax-free retirement growth. For example, did you know that with the solo 401k, you can put away both employer contributions, while the mega backdoor Roth uses a special tax contribution strategy to funnel even more money into Roth accounts? One focus on maximizing pre-tax deductions or Roth contributions, while the other is all about supercharging your Roth savings beyond the usual limits. Please also type over your questions. We'll discuss them here on the live webinar. They don't have to be pertaining to today's topic, which is what is the difference between solo 401k and mega backdoor Roth. Please also like our video today, subscribe to our channel to help get the word out to other solopreneurs like yourself. I don't see any questions at the moment, so let's get started with today's topic. And again, you can shoot over or type over your questions regarding solo 401k plans, IRAs, and even the rollover business startup 401k, as well as traditional 401k plans. And we'll pause and answer those questions as they come in. So let's see here. So as discussed, solo 401k and the mega backdoor Roth are powerful retirement tools. They both allow you to supercharge your retirement savings. However, they are different with respect to how they impact your taxes when making contributions, as well as when making distributions, typically at retirement age. Let's first talk about what a solo 401k is. So a solo 401k is for the self-employed, that is owner-only businesses. So if you have multiple owners in the business, all the owners can participate in that same solo 401k plan. Once in a while, we'll come across clients who open up a solo 401k where their business, let's say it's an LLC, has 4 owners. And they can all participate in that same solo 401k plan because, again, solo 401k plans are for owner-only businesses. So they're for owners in the business. And also, the owner's spouse or spouses can also participate in the plan. So you may end up with a solo 401k plan that has 8 participants in the example I just gave, where you have 4 owners working for the business, and then their respective spouses also work for the business. So don't let the word solo, which means one or solely, make you think that it's only for a one person. Most of the plans we open, we find that they're either for just one individual, so the business owner, or that individual and his or her spouse. So a two-person plan. So keep in mind, it's still considered just one solo 401k plan when you have multiple participants like you and your spouse, for instance. Each spouse would have separate holding accounts under that solo 401k plan to hold their respective contributions and funds. Because at the end of the day, a solo 401k is a defined contribution plan, just like traditional 401k plan. And the 401k regulations call for separately tracking each participant's funds under the plan. If you're looking to open a solo 401k plan from an eligibility perspective, if your business employs any non-owner W-2 employees who work 1,000 hours or more, then you cannot open a solo 401k plan. So that's the 1,000 hour requirement. You would not be able to open that solo 401k plan. And again, that would only apply if you employ W-2 employees who are not owners in the business, but to use IRS terminology, common law employees who work 1,000 hours or more. If you hire contractors, you can exclude contractors regardless of how many hours they work. You can also exclude those employees who are under age 21, regardless of how many hours they work. You can also exclude union employees. So those are things to be aware of with regard to the eligibility requirements. Now, from a contribution perspective, as far as the types of funds that can be contributed to the solo 401k plan, you can make pre-tax contributions, whether employee or employer pre-tax contributions. You can also make Roth contributions, whether employer Roth contributions or employee Roth contributions. Secure Act 2.0 now allows for the business owner to make employer Roth contributions. It used to be prior to the Act, the Secure Act 2.0, that employer contributions had to be made on a pre-tax basis. Well, that changed. And now, just like employee Roth contributions, you can also make employer Roth contributions. And of course, the solo 401k does allow for voluntary after-tax solo 401k contributions as part of that mega backdoor Roth strategy, which we're going to be talking about more here today. Again, please like today's video, subscribe to our channel so that you receive notifications when we go live. We typically go live a couple times a day, at least once a day, but oftentimes a couple times a day. We'll be going live again today, for example, here in a few hours. So if you don't get a chance to ask your questions during today's session, you can come back and ask them at the session we'll have later today. Okay, so with the solo 401k, you can also make higher contributions than you can to IRAs. For example, for tax year 2025, the solo 401k annual contribution limit is $70,000 for those who are under age 50. For those who are age 50 or older, you can also do an additional catch-up amount of $7,500 on top of that $70,000 figure. And then there's the super catch-up contribution for those who are ages 60, 61, 62, or 63, where you can make a catch-up contribution of $11,250 instead of $7,500. That's called a super catch-up contribution, and you've got Secure Act 2.0 to thank for that. So conceivably, if you're age 50 or older, you can contribute as much as $77,500 to a solo 401k plan for tax year 2025. Likewise, if you're full within that age range I talked about at 60, 61, 62, or 63, you can make the super catch-up contribution. And when you add that to the normal contribution of $70,000, you can contribute a total of $81,250 to that solo 401k plan for tax year 2025. It's important to note that that super catch-up contribution did not become available till 2025. So it was not available for prior years. Okay, let's keep on moving on here. Again, today's topic is what is the difference between solo 401k and a mega backdoor Roth? Go ahead and type over any questions you have during the webinar and we'll go over those. So what is a mega backdoor Roth strategy? Well, one, it's not available in all 401k plans. Why? Because the business that sponsors that 401k decides what types of contributions to allow into the 401k. For example, typically large corporations, whether we're talking about, let's say, the Home Depot or we'll say Microsoft or NVIDIA, they may not allow for the mega backdoor Roth 401k, where you can make voluntary after-tax contributions, because the business owners decided that they don't want to allow for voluntary after-tax contributions. Now, when you are self-employed, you're the business owner, so you can choose to open a solo 401k plan that allows for the mega backdoor Roth strategy. However, even if you choose to allow for that mega backdoor Roth strategy, you still have to clear another hurdle. That is, you have to find a company that will provide a solo 401k plan that does allow for A, voluntary after-tax solo 401k contributions, B, for conversions, and then C, for the mega backdoor Roth strategy. So you got to meet that ABC, those three items there. So here in my solo 401k financial, we draft the plan documents for the maximum flexibility under the IRS regulations. Therefore, we've already checked everything within the plan to allow for the mega backdoor Roth strategy, which is making voluntary after-tax solo 401k contributions, conversions, and of course, performing the mega backdoor Roth strategy. Not all solo 401k providers offer that. Most of the traditional solo 401k providers do not allow for the mega backdoor Roth strategy. Providers such as Fidelity Investments, Charles Schwab, and even banks do not allow for it. However, here in my solo 401k financial, again, we've drafted the plan so it does allow for it, among other things, like being able to take a solo 401k participant loan, the option to invest in alternative investments, whether it's private equity, real estate syndicates, physical real estate, precious metals, tax liens, judgments, promissory notes, even cryptocurrency. The list goes on and on. So the mega backdoor Roth strategy is a way to maximize your annual 401k contributions. And you can really go beyond the typical contribution amount because it's a dollar for dollar calculation. It's not a percentage calculation when trying to determine how much you can contribute to the plan. Whereas employer contributions, those calculations are always done on a percentage basis. For example, if you're self-employed, business is taxed as an S corporation, the employer contribution is going to be based on 25% of your W-2 wages. If it's a sole proprietorship or a partnership, it's going to be based on 20% of line 31 of your Schedule C or the applicable line number of that Schedule K1. I can't remember the line number. I'm thinking line 14 or 15, which is titled self-employment income. And then you have to subtract 1/2 of self-employment income tax from that figure. And then the difference you can make as an employer contribution, which would be 20% of that figure. Now let's keep talking about those figures. Let's provide an example. Let's say Sally is self-employed through an LLC, taxes and S corporation. She opens a solo 401k plan. It's sponsored by her self-employed business, the LLC, taxes and S corporation. Sally wants to maximize her voluntary after-tax solo 401k contributions to the plan. Sally is also under age 50, and she wants to make contributions for tax year 2025. So after she opens the solo 401k plan, she's ready to contribute to it. So here at my solo 401k financial, we help our clients calculate those contributions. So let's say that Sally pays herself, let's say Sally wants to know what's the minimum amount of W-2 wages that she needs to pay herself from her self-employed business taxes and S corporation so that she can maximize her mega backdoor Roth strategy by making voluntary after-tax solo 401k contributions and subsequently converting those contributions to a Roth IRA or the Roth solo 401k. We'll talk more about whether you should convert to the Roth solo 401k or the Roth IRA after making that voluntary after-tax solo 401k contribution. So again, in this example, Sally wants to supercharge her retirement account savings on a Roth status. So that's where the voluntary after-tax solo 401k contributions really come into play. So the reason Sally doesn't want to report more W-2 wages than she needs to, but she does want to maximize that mega backdoor Roth strategy, which again, the maximum contribution limit is $70,000 for tax year 2025. So Sally is only going to need $70,000 so that she can maximize her mega backdoor Roth strategy for tax year 2025. And even if Sally has a daytime 401k and she makes any type of contribution to that 401k, or even if that employer contributes to that daytime 401k, that's not going to impact Sally's ability to still turn around and also maximize her mega backdoor Roth strategy by making voluntary after-tax solo 401k contributions. Because voluntary after-tax solo 401k contributions are not impacted by contributions that you make to another 401k, such as your daytime employer 401k. That's why we get a lot of doctor clients and attorney clients where they may participate in their daytime employer's 401k and they maximize the contributions to that plan. Well, they also have a side business, so they open up a solo 401k and then they maximize their mega backdoor Roth strategy through that self-employed business that set up the solo 401k plan all the way up to the overall limit of $70,000. So again, the reason why Sally doesn't want to make more than $70,000 is because if she makes more than $70,000 in W-2 wages, well, that's going to subject her to additional taxes as well as payroll taxes. So the reason why she wants to make at least $70,000 of W-2 wages from her self-employed business, taxes and S corporation, is because that's how much she will need to maximize the mega backdoor Roth strategy, because again, it's a dollar for dollar calculation. It's not a percentage calculation like employer contributions. So Sally pays herself $70,000 in W-2 wages. She can turn around and then contribute that entire $70,000 to the voluntary after-tax solo 401k holding account and turn around and immediately convert it to the Roth solo 401k or the Roth IRA. And now Sally ends up with $70,000 in Roth solo 401k money or Roth IRA funds. So talk about really supercharging your retirement savings on a Roth basis by utilizing the mega backdoor Roth strategy. So as you can see, by the example I just gave, you can easily get a lot more money into a Roth solo 401k than you can into a Roth IRA, because the Roth IRA contribution limits are only $7,000 for 2025 or $8,000 for those age 50 or older. And again, you can also choose, now you can also make your Roth IRA contribution as well. Your Roth IRA contributions are not impacted by your Mega Backdoor Roth strategy. So you could still do the $70,000 voluntary after-tax solo 401k contribution, turn around, convert it to the Roth solo 401k or the Roth IRA, and then turn around and also make a $7,000 Roth IRA contribution. Of course, there's a caveat to that. You want to make sure that your modified adjusted gross income is not over a certain dollar amount, because Roth IRAs, unlike solo 401k plans, are restricted by your modified adjusted gross income. But even then, there's such thing as the Backdoor Roth IRA, where you make a contribution to a non-deductible IRA if you don't qualify for that Roth IRA contribution. And then once you make that $7,000 contribution to that non-deductible IRA, you can then turn around and convert that IRA to the Roth IRA. And that's even if you maximize your Mega Backdoor Roth solo 401k. Of course, if you're doing a Backdoor Roth IRA that I just described, that strategy, when you go to convert those non-deductible IRA funds, you want to make sure you isolate those IRA funds. So if you have other IRAs or even simple IRAs or SEP IRAs, that's going to impact how you convert that after that non-deductible IRA contribution. So if you want to isolate those other IRA funds, you can transfer those to the solo 401k, to the pre-tax solo 401k, because the solo 401k does allow for income and transfers from former employer plans, whether it's a SEP IRA, simple IRA, or 401k, even a thrift savings plan, 457B, 403Bs, all those letters of the alphabet. Those can all be transferred to a solo 401k plan, and that's a way to isolate those non-deductible IRA contributions so that you can perform the Backdoor Roth IRA. We don't want to get too much in the weeds with the Backdoor Roth IRA. We've gone over that in prior webinars. You can go to our YouTube channel and download that video that we've done on that topic. But I can sit here and talk about this all day long. Okay, we already talked about how you can convert those voluntary after-tax solo 401k contributions to the Roth 401k or the Roth IRA. All right, let's pause there. It looks like we've got some questions here. Let's see, we've got a question here from Timur. I'll be 60 years old this year. Well, congratulations. I just turned 50 myself this year. So I can make catch-up contributions. Okay, I want to contribute the maximum after tax, which will be $81,250. I also want to max my personal Roth IRA. Does this mean my W-2 should be $89,250? Great question. So let's break down the contribution limits. One, since you're age 60, you qualify for that super catch-up contribution amount of $11,250. And again, we're talking about tax year 2025 figures. And then the $70,000 overall limit, that can be contributed to the voluntary after-tax solo 401k plan. And then you can convert that $70,000 right away so that there are no gains. You always want to convert those voluntary after-tax solo 401k contributions right away so that there are no gains, because any gains converted to the Roth solo 401k or the Roth IRA will be subject to taxes. I mean, typically it's only a few dollars of gains. But again, the takeaway is you want to convert right away. So that $70,000 would be deposited directly into the voluntary after-tax solo 401k holding account. that is the bank and or brokerage account. And then if you, and then again, you want to convert it right away to the Roth Solo 401k or the Roth IRA. We'll talk more about what steps are involved in the mega backdoor Roth conversion process. But let's keep going here for now. And then as far as the super catch-up amount of $11,250, I'm glad you asked that question, because the super catch-up contribution can never be deposited to the voluntary after-tax solo 401k bucket. In other words, it does not qualify for the mega backdoor Roth strategy. But that's okay. No need to get concerned. Why? Because you can apply that $11,250 directly to the Roth solo 401k bucket. Because remember, the solo 401k plan offered by my solo 401k financial allows for pre-tax contributions, Roth contributions, and of course, voluntary after-tax solo 401k contributions. And when you open a solo 401k plan, you're going to have 3 separate holding accounts, buckets. So one plan with 3 separate buckets to hold each source of funds. It could end up being more buckets if your spouse also participates in the plan. Then it would be a total of 6 buckets, because each spouse is required to have separate holding accounts for their funds, including the fund sources. But let's just stick with the one participant here. So you would have one solo 401k plan that has 3 brokerage accounts, because our clients have the ability to choose where they want to hold their money at. Many of them decide to hold their funds for the solo 401k plan at Fidelity and Schwab. And yes, you heard that right. Fidelity and Schwab do offer their own solo 401k plans, but they will also provide what they refer to as company non-prototype brokerage accounts for solo 401k plans offered by my solo 401k financial. And then they understand that it's my solo 401k financials plan that allows for the mega backdoor Roth strategy, and that my solo 401k financial will be performing the reporting for that plan in conjunction with the trustee of the plan, which is you. So that $11,250 would get deposited into the Roth solo 401k brokerage account. So again, the catch-up contributions, whether the $7,500 for those over age 50, or the super catch-up amount for those age 60, 61, 62, or 63 of $11,250, that can never be deposited to the voluntary after-tax solo 401k bucket. But that's fine, because you can contribute it directly to the Roth solo 401k bucket. So that's number 2. With regards to the Roth IRA, again, yes, you can also contribute, in your case, $8,000 to a Roth IRA, provided that your modified adjusted gross income is under a certain limit. But even then, you can always do the backdoor Roth IRA if necessary. And then 3rd or 4th there, yes, you're going to need to pay yourself $89,250 if you want to maximize the mega backdoor Roth strategy, the voluntary, the super catch-up contribution, as well as the Roth IRA contribution. Great question. All right. Let's see here. Looks like we already answered that question. By the way, I have an S corp. Great. So if you have an S corp, then you would pay yourself in W-2 wages in a total amount of $89,250, so that you can maximize your mega backdoor Roth, your super catch-up contributions, as well as your Roth IRA contributions, or even backdoor Roth IRA contributions. All right, great questions. Again, please go ahead and type over your questions during today's webinar. Today's topic is, what is the difference between solo 401k and mega backdoor Roth IRA, or mega backdoor Roth, I should say. And again, the questions you type over don't have to be regarding today's topic specifically. They can be regarding any topic regarding solo 401k plans, self-directed IRAs, and even the rollover business startup 401k. So let's pick back up here with today's daily topic. So we've already discussed this first bullet point here regarding what a solo 401k is and who qualifies. Oh, let me go back to that. We've already talked about how the Mega Backdoor Roth works, but we're going to get into that a little bit more in depth now. And we're also going to talk about why it's not for everyone. I mean, it typically does make sense, but in some instances, it may not be for everyone. And we're going to talk about the differences between voluntary after-tax contributions as well as the other contribution types, like pre-tax contributions, whether employee or employer, as well as Roth contributions, whether employer Roth or employee Roth. So let's talk about how the Mega Backdoor Roth strategy works. Let's talk about the process. We've already talked about the maximum. We gave an example as to how to maximize that contribution for someone who's self-employed, where they have an LLC, taxes and S corporation. But let's talk about the actual steps. So again, first you need to make sure you find a solo 401k provider who does provide a plan document that allows for the Mega Backdoor Roth solo 401k strategy. Here with my solo 401k financial, as I touched on already, we do provide the Mega Backdoor Roth strategy, so it is part of the plan already. It's already built into the plan. And then after that, after you decide which solo 401k provider to use, then it's time to open up the solo 401k plan holding accounts. You're going to need to, so step one is you're going to need to open up at least 2 bank or brokerage accounts under that solo 401k plan. The first brokerage account is going to be used to hold the voluntary after-tax solo 401k contributions, because you have to make the contribution to that separately labeled holding account, which will be labeled voluntary after-tax. You cannot deposit those funds as part of the Mega Backdoor Roth directly to the Roth solo 401k. It has to make a pit stop first, and that goes into the bank or brokerage account under the solo 401k plan labeled voluntary after tax. So that's step one. Now you also need to have a second bank or brokerage account labeled Roth solo 401k. So it's still the same plan, but the second brokerage account is where you will convert those voluntary after-tax solo 401k contributions to. So from the voluntary after-tax solo 401k brokerage account to the Roth solo 401k brokerage account. And then you can open a third brokerage account if you also want to make pre-tax contributions, or if you want to transfer IRAs or former employer plans to the solo 401k. Now, if you plan to solely make voluntary after-tax solo 401k contribution and then convert it to the Roth solo 401k, then you just need 2 holding accounts, that is brokerage accounts or bank accounts under the solo 401k. One labeled voluntary after-tax, and the second one labeled Roth solo 401k. Another example, let's say that you want to convert your voluntary after-tax solo 401k contributions to a Roth IRA. So you do not want to convert those to the Roth solo 401k. Under that scenario, then you only need 1 voluntary after-tax solo 401k brokerage account under the solo 401k. And then if you don't already have a Roth IRA, then you're going to need to open up a Roth IRA, and then the voluntary after-tax solo 401k contributions get converted to that existing Roth IRA that you have already, or if you don't have one, to that new Roth IRA. So step 2 is where you make the contribution to the voluntary after-tax solo 401k bucket. And then step 3 is where you convert. You move the funds from the voluntary after-tax solo 401k bucket to the Roth solo 401k bucket or the Roth IRA. Step 4 is where you need to complete our online conversion form, because keep in mind, neither the bank nor the brokerage firm is going to perform the reporting for that Mega Backdoor Roth conversion. Instead, the solo 401k provider will assist with that. While not all solo 401k providers offer their reporting support, here are my solo 401k financial we do. That's going to be reported on a form 1099-R with a copy sent to you and a copy to the IRS. So In order for us to know that you processed that mega backdoor Roth conversion, you need to complete our online conversion form, which you can find on the Forms tab of our website. On the top right-hand corner, there's a Forms tab. And when you fill out that form, that's going to prompt us to prepare that Form 1099-R. As long as you timely request that Form 1099-R, we're not going to charge additional fees for that service. And the conversions are reported for the year that the funds are actually converted. So if you are going to convert any voluntary after-tax solo 401k funds to the Roth solo 401k or the Roth IRA here in 2025, you need to make sure you move those funds to the respective Roth solo 401k holding account or the Roth IRA so that you know the total amount converted, and to then complete our online conversion form so you list the total amount converted. You want to do that by December 31st of this year. So that accounts for tax year 2025. And then step 5 is where we issue that Form 1099-R to the IRS and a copy to you. Okay, please subscribe to our channel to help get the word out to other solopreneurs like yourself. And go ahead and type over any questions you have. In the meantime, we'll continue with our topic today, which is what is the difference between solo 401k and mega backdoor Roth? So let's talk about why it's not for everyone. So the reason why the mega backdoor Roth strategy is not for everyone is because some individuals want to make pre-tax contributions, because pre-tax contributions reduces your taxable income for the year. So if you're in a high tax bracket and you're trying to reduce your taxable income, then it's not going to make sense to make voluntary after-tax solo 401k contributions, because when you make a voluntary after-tax solo 401k contribution, you don't get a deduction for that contribution, whether on the personal side or the business side. But the trade-off is that you then convert those to the Roth solo 401k or the Roth IRA, and all those gains are going to grow tax-free. And therefore, when you make distributions later on, once you qualify for those distributions, you won't have to pay any taxes on any of those gains. So if you're trying to save on your taxes now, then the mega backdoor Roth is not going to be a good strategy for you. That's really the only instance where it would not make any sense. Now, another instance, I guess, that you can think about is if you think that our federal tax rates are not going to go up in the future, which, I mean, I don't see why they wouldn't go up, especially the amount of debt that this country's in. So if you don't think that you're going to be in a higher tax bracket down the road, then maybe the mega backdoor Roth strategy is not for you, and you may want to make pre-tax contributions so that you can save on taxes now. So, and in short, you'll want to discuss your financial situation with your financial advisor, whether you should make pre-tax contributions or voluntary after-tax contributions, for example. Okay, let's talk here about, we get this question quite a bit, quite often. Clients ask, when I make a voluntary after-tax solo 401k contribution, should I convert those funds to the Roth IRA or to the Roth solo 401k? So we put this image together to help those individuals make an informed decision. So when you convert the funds to a Roth IRA from the voluntary after-tax solo 401k bucket, it still needs to be reported to the government. That is that conversion. So whether you convert those voluntary after-tax solo 401k funds to a Roth IRA or the Roth solo 401k, they still have to be reported on a Form 1099-R to the government so that you get credit for it. As far as converting to the Roth IRA, clients will convert to the Roth IRA because they're not going to be self-employed anymore. Because once you stop being self-employed, you have to close the plan down. So they might be getting ready for that. So they'll just go ahead and convert it to the Roth IRA, or They could always convert it to the Roth Solo 401k, and later when they close down their business at that time, they can transfer the Roth Solo 401k to a Roth IRA. But we find that most clients like to convert to the Roth Solo 401k because the Roth Solo 401k plan allows you to take a loan from it where you can borrow 50% of your total Solo 401k balance, up to $50,000, and then pay yourself back. And when you pay yourself back, then, or what should I say, when you pay back your own 401k, you're paying it back with principal and interest. So that interest goes back into your Roth 401k. So that's how you can indirectly get more Roth 401k money into your plan by borrowing from the Roth 401k. Also, those that like to invest in real estate oftentimes prefer to do so through the self-directed Roth Solo 401k instead of a Roth IRA because you can utilize debt financing and non-recourse loan with both. But if you utilize debt financing with the Roth IRA when investing in real estate, that's going to subject our Roth IRA to unrelated debt finance income tax, which is typically at the trust tax rates, which is typically about 38%. That tax does not apply to Roth Solo 401k plans that utilize debt financing for investing in real estate. So those are some of the reasons. And of course, just like Roth IRAs, Roth Solo 401k plans are not subject to required minimum distributions. All right, looks like we've come to the end of our session today. We appreciate you joining, asking your questions. We'll be live again here in a few hours. Until next time, have a good rest of the day.